Let's talk about a problem that so many of us face. You're looking for real, meaningful income from your investments, but you're tired of chasing those high yields that, let's be honest, just come with high anxiety. It's a huge challenge. Well, today, we're going to dig into an ETF that claims to have an answer. It's called PLTY. I mean, this is the classic dilemma, isn't it? And I'm sure it's a feeling you know all too well. You see those juicy-looking yields, but in the back of your mind, you can't help but feel like there's a catch, right? Some kind of hidden trap waiting to spring. You want your money to work for you, for sure, but you also want to sleep at night. It's this constant tug of war. Yeah, and this quote from Tony Hicks, it just hits the nail on the head. The hunt for yield can feel like you're navigating a minefield. So many products out there promise you the world, but they end up being way too complex, way too risky, or just a big letdown. And this is exactly the kind of environment a fund like PLTY was designed to tackle. So, what if there was a solution that wasn't a trap? The article we're exploring today makes a pretty bold claim, calling PLTY close to perfect for a certain kind of investor. So, let's really dig in and see what that means. Okay, so here's the official breakdown. PLTY is a covered call ETF. Now, if you're not familiar, a covered call strategy is really just a way to generate income. Think of it like this. You're collecting rent on stocks you already own. And the key here, the foundation, is that PLTY builds this strategy on a portfolio of big, stable, high-quality American companies. So how does this thing actually generate all that income? Let's pop the hood and take a look at the mechanics. It's actually a pretty elegant three-step process. Okay, step one. PLTY owns what the source calls boring greatness. We're talking solid, dependable, large-cap value stocks. Step two, it rents out the upside by selling call options on the S&P 500 index. This brings in a stream of income called a premium. And then step three, and this is the part you're probably most interested in, it takes that premium, combines it with stock dividends, and pays it all out to you every single month, like a predictable monthly paycheck from your portfolio. Now look, a lot of funds use a covered call strategy, but the source argues that PLT's execution is what really makes it stand out. First, that disciplined focus on quality stocks means they aren't just buying random stuff. They're targeting real companies with strong financials. Second, this dynamic option writing part is a huge deal. It means they aren't just blindly selling calls. They're actually adapting to the market to try and optimize that income. And finally, that tax-efficient structure. We're going to get to that in a minute, but trust me, it's a really big advantage. It's all about how they do it. And of course, PLT isn't operating in a vacuum. This whole covered call space, well, it's become a really crowded playground. There are some big, popular names out there. So to really get what PLT is about, we've got to see how it stacks up against the competition. This table does a great job of laying it all out. You can see the different philosophies here. You've got XYLD, which is super simple but caps your upside pretty hard. Then there's the big one, JEPI, which is more active but uses these complex things called ELNs. You've got DIVO, which focuses more on dividend growth. But then you look at PLTY, and you can see it's really aiming for that sweet spot right in the middle, trying to balance that nice high yield with still being able to participate in some market growth. The source puts it perfectly. It feels engineered, not merely assembled. So let's just zero in on the number that matters most if you're looking for income. We're talking about a typical annual yield somewhere in the neighborhood of 7 to 10%, and that's paid out monthly. Now, just to put that in perspective for a second, a traditional portfolio of, say, 60% stocks and 40% bonds might only be yielding around 3% right now. So yeah, we're talking about potentially double or even triple the cash flow. Okay, but you and I both know there's no such thing as a free lunch in investing, right? That predictable income, it comes at a price. Every single covered call strategy, I don't care how well it's designed, involves a trade-off, and it is absolutely critical to understand what you're giving up to get that yield. And here it is, laid out plain and simple. On one side, what you give up is the potential for those absolutely explosive runaway gains when the market is just on fire. You know, when the S&P 500 rips up 25% in a year, PLTY is going to lag behind. That's a fact. But here's what you get in return. A buffer when things go down, because that option income helps soften the blow. And of course, you get that stable, predictable stream of income month after month after month. To make this really hit home, let's imagine two different investors. First, let's meet Chad the Chaser. Chad just owns the S&P 500, and he is glued to his screen all day. He's always chasing that last little bit of performance, and every time the market dips, his stress level just goes through the roof. He's totally focused on maximizing every single percentage point of gain. Now, let's contrast that with Grace the Gatherer. Grace owns PLT, but her entire mindset, it's just different. She's not trying to beat the market. She is focused on one thing. Collecting her income, she reinvests it, she tunes out all the daily noise, and maybe most importantly, she sleeps well at night. PLT, it's built for the Graces of the world. It's for investors who care more about peace of mind than chasing every last dollar. All right, now there's another really important advantage here, and it's one that often gets overlooked: taxes. Because PLTY uses broad index options on the S&P 500, its gains get a special, more favorable tax treatment. As you can see, 60% of the gains are taxed at the lower long-term capital gains rate, and only 40% get taxed at the higher short-term rate. If you're investing in a regular taxable account, this can make a really big difference in how much you actually get to keep. So who is this really for? I mean, who's the ideal investor here? Well, it's a powerful tool for a few key groups. You've got retirees who need that consistent monthly check to pay the bills. You've got dividend investors who are just sick and tired of chasing risky stocks that might slash their payout. And frankly, you've got any investor who just wants to lower the overall volatility of their portfolio and enjoy a bit of a smoother ride. It's also really important to set the right expectations. A strategy like this is built to shine when the markets are just going sideways, or when they're choppy and volatile, or even when they're down a little bit. In those environments, you're just collecting that income while everyone else is stressing out. It will, by its very design, underperform when the market is just rocketing straight up. So let's wrap all this up. What's the big takeaway? Is PLTY really the path to, as the source material puts it, covered call enlightenment? You know, I want to focus on this fantastic quote because I think it gets to the absolute heart of the matter. Compounding peace of mind is just as valuable as compounding capital. Investing isn't just about spreadsheets and numbers, it's about our behavior, our emotions. Any strategy that helps you stay calm and stay invested through thick and thin has this incredible value that's hard to put a number on. So look, here's the bottom line. PLTY isn't promising you perfection. It's not going to capture all of the market's upside with none of the risk, because that's a fantasy, it doesn't exist. What it does offer is something much more realistic and, for a lot of people, a lot more valuable. Clarity, consistency, and a strategy that's designed to help you stay the course. And that really brings us to the final question, the one you have to ask yourself. In a world full of financial complexity and nonstop hype, is a strategy that's simply close to perfect, one that's clear, consistent, and built to manage your own behavior, is that good enough for your goals and for your peace of mind?